Howdy out there, folks. This is Darius Dale here to present our macro minute for February 10th, 2022. Starting with markets, we have stocks mixed this morning, commodities up, crypto up, dollar down, global bond yields mixed. Big movers, we have copper up 2% this morning. Shifting gears to the macro front, the latest batch of global inflation data suggests the bulk of global monetary policy tightening lies ahead of us. So, looking at core CPI data out of Mexico, accelerated to 6.2% year over year in January. That's the highest print we've seen since September 2001. Core CPI data out of Brazil accelerated to 8% year over year in January. That's the highest print we've seen since May of 2016. Core CPI data out of Russia accelerated to 9.2% year over year in January. That's the highest print we've seen since January of 2016. Core CPI data out of the Netherlands accelerated to 2.7% year over year in January. That's the highest print we've seen since August 2013. And then lastly, the trend mean CPI statistic out of Australia accelerated to 4.6% in February. This is the survey reading. That's the highest rate we've seen in a couple of months and maybe a leading indicator of inflation pressures continuing into Q1 of this year. Taking it to the chart here, what we're showing in this chart are overnight index spreads forwards. Ignore all that nomenclature for those of you who are not familiar with the rates market. But the reality is what we're trying to show is how much our rates markets pricing in terms of monetary policy easing or tightening relative to the benchmark policy rate. Is the Fed in the first panel, ECB in the second panel, and the Bank of England in the third panel. What you see here is the U.S. markets are pricing in somewhere between sort of 6 and 7 hikes over the next year. ECB pricing in somewhere between 3 to 4 hikes over the next year, and then the Bank of England the markets are pricing in somewhere between 5 and 6 hikes over the next year. Those are the blue lines in these respective charts. And so obviously these being the sort of big three, excluding the BOJ, kind of the big three central banks here that are set to tighten monetary policy over the medium term. Going back to inflation, today at 8:30, we'll get the U.S. CPI data for the month of January. There's some revisions to the basket in terms of isolating it for the post-pandemic spending consumption patterns. And those revisions, in our opinion, support Bloomberg economists' consensus expectations for headline CPI to accelerate 20 basis points to 7.2% and core CPI to accelerate 40 basis points to 5.9%. Our analysis of the changes suggests we could easily see a 6 handle on core CPI, which will be the first 6 handle since August of 1982. Shifting gears to today's probable range setups, overbought signal in the Russell 2000, the Australian dollar, 10-year JGB yield, oversold signal in the VIX and the VVIX index. So that's the volatility. S&P 500, that is still neutral VAMs with 7% of downside versus 2.3% of upside. WTI, that is neutral VAMs with minus 9% of downside versus 4% of upside. Bloomberg Dollar Index, still bullish VAMs, minus 0.1% of downside versus 1.8% of upside. 10-year Treasury yield, still bullish VAMs, minus 17 basis points of downside versus 12 basis points of upside. Bitcoin, minus 23% of downside versus it's still at its upper boundary of its probable range. That is starting to shift higher, so that's a usually bullish leading indicator, so be aware of that. Same thing with Ethereum, still bearish VAMs, minus 29% of downside, but still at the upper boundary of its probable range. Again, continuing to probe the upper boundary is usually a leading indicator for that medium term, that volatility adjusted momentum signal state to change. And then lastly, gold neutral VAMs, minus 2.8% of downside versus 1.1% of upside. So with that, Darius Dale presenting our macro minute for Thursday, February 10th, 2022. If you like what you see, come check us out at 42macro.com. Cheers.